today's conversation with Davon Cook from Pinion, we're going to explore some of the variables that can be thorny in family business compensation and how to address them. Hi, Davon. Please introduce yourself.
Great. Thanks for having me, Bill. I'm Davon Cook. I am part of Pinion, which is a accounting and consulting firm that's kind of mostly specialized in the food and agriculture industry here in the U.S. So most of my clients are in production ag or inputs or ag processing or food manufacturing. And in that sector, lots and lots of family businesses. And my specific specialty is family business advising. Most of my clients are at that stage of the family business life cycle. They started survival, then they became stable. Now they're in this professional range where their business has grown enough that they're dealing with multiple branches of the family owning it, and they're realizing they need more governance and better communication. And they're also at a growth stage and life stage where there's a lot of very important key talent that are not family members. And so that's where this compensation question often comes up, both regards to family members and how that interacts with the rest of their team. And so all sorts of the topics that we're going to get into today.
It's such an interesting opening statement because one of the lines you use there from survival and growth, and I've got the list of the points on the side of my screen here. All of these points, in a lot of ways, can be looked at the lens that are normal or even appropriate when you are a very small or surviving business. But as you scale, these practices begin to become more thorny and more difficult and more likely to create problems somewhere in the system. And I think the first one is the difference between ownership pay and employment pay. And when you're a small business, and particularly if you're a sole proprietor, and it can be whatever you want it to be. When you look at the circumstances with your clients and differentiating between these two things, what are the challenges and opportunities that you see?
Yeah, if you think about the three circles of family business, which probably lots of our listeners are acquainted with, you have these roles as an owner and a manager and a family member. And in a lot of cases, they overlap. Instead of being three circles in the Venn diagram, they can be one or close to one. And so when you're in that mindset, it doesn't really matter where the money's coming from, right? It's the same pot. But as these businesses grow and professionalize, you're going to get into more and more situations where you have key management members that are not owners, and vice versa. You have owners that may not be working at management, and those two circles have separated. So, that's a typical evolution, and how you're you can do yourself a big favor by, even before you're at that stage of evolution, if you can think about those two buckets of money differently. So, return to owning an asset is what a dividend I get from owning stock in Ford Motor Company, or what distribution I get from LLC or the S Corp that I'm an owner in. And those are, return for having capital invested. I can put my $1,000 in the stock market, or I can put my $1,000 into this business, and I'm expecting a return on that investment. Versus when I have my management hat on, I'm getting paid for a job I do. There is a concept, a definition of compensation in family business that I first heard years ago from Kim Schneider-Malik that I like. And it's that we get paid 4 different ways in family business. First is we get paid for what we do. So the job we have, the salary for doing our day job. We get paid for how well we do that. So that would be bonuses and incentives for doing your job well, or the company profit share, having a banner year. The third one is we get paid for what we own. So that's the return on investment I was just speaking about. And then the fourth one, which sometimes we don't like to acknowledge or admit in family business, is we get paid sometimes for who we are. And that is access to the perks of, a house or the family vacation, or that we're going to receive an inheritance, or that, maybe the business has done well and parents are generous with some annual gifting, or all sorts of other things that family members do for their family that they love. But the more that you can be clear on the distinctions between those 4 buckets and just acknowledge them for what they are, the better that serves you long term.
Yeah, I think that those 4 buckets are really a really insightful way to break down how different compensation can be accrued for a family member in a business. However, what I see is something a little different in most cases. Like there's kind of what the best practices laid out in a textbook, and then the practices that occur in operating companies. And the most common thing that I see is there's a double standard of employment payment. So you have your non-family employees who have, just to use a simple round number, a base salary of $100,000. And the family member who has the same job and same responsibility has a base salary much higher than that. And that double standard is meant for owner comp and employment comp. And it can be a little bit more wrinkly because maybe that family member is not an owner now, right? Maybe they are in the estate plan to own the company at some point in the future. But there is this kind of in compensation, and this does bleed into other types of employment policies, a double standard that gets set up within a business where, well, if you're a member of the family, you have access to perks that are both in terms of compensation, but also expectations that have a significant impact, not just on the psychology of the family members in the workplace, but also what we tend to find is our work is really focused on working with non-family executives, that families oftentimes are unaware of the negative impact that has on the culture of the business itself. That when you have people who are doing the same work for different levels of pay and different levels of accountability in some cases, it is discouraging to the people in the workplace. So what we try to move the needle towards is that the compensation for employment is market rate for all people. And if you are a family member, there maybe is some other family perk that you're allocating revenue towards that is a different bucket. And then you need to account for that in how you're investing the revenue back into the business versus perks for your family. But what you want from a culture standpoint is that people are feeling there is a culture of fairness where all people are treated equally within the business.
Absolutely. And there's a lot of real life scenarios embedded in what you just said. I do think what you said, if you can keep the salary the same and at market rate, and then just acknowledge that fourth category I mentioned of, you are paid for who you are. And so in some cases that is some perks and trips. And I can even think of situations where I've seen families just admit like, hey, family members are going to get a little bit more vacation. Now, one can absolutely argue that may not be best practice. I'm just saying in reality, sometimes it's reality. And I'm a pragmatist of if we're going to do some of these things that do have potential for negative consequences and negative morale with others, let's do them in the light of day and with some process and some acknowledgement of them. And so, maybe that is the policy that, family members are expected to attend. They're expected to attend the family council meeting and the family reunion. And we consider that important, not just for our personal family, but we also consider that important for the longevity of the business, right? For all sorts of reasons. So we're going to recognize that maybe they're going to get a week or two extra vacation because some of these obligations because of who they are. And I'm not saying that every non-family employee loves that, but it happening in the light of day with clarity of what the process and rationale is, I think is healthier than it happening and people feeling there's no accountability to it whatsoever.
Right. And speaking from being in a family business myself, working on compensation policy internally for my own family has been an ongoing conversation. But what we find is that what we kind of grew out of an area where there was compensation ambiguity, and that ambiguity about why money was being paid out in particular ways, a point of friction. And while there was consternation about addressing the conversation, actually coming into a conversation and saying, hey, we need to be clear about how this works and what those policies and procedures are.
Right.
Even though it was uncomfortable to begin the conversation, it was very clear when coming into it with good faith that the pressure in the room really kind of normalized really quickly in a way that was unexpected for us. And I would imagine that's true for a lot of families.
Yeah. And I think that theme resonates a lot. We'll probably come back to throughout this conversation is sometimes getting the elephant in the room talked about while you're dreading it and you're worried about all the ways it could go badly. Sometimes it's just a pressure release valve that we are talking about and even if we don't agree, we're at least talking about it and kind of understanding the rationale of why people are advocating for different things.
Mm-hmm.
But it's so common in my medium-sized business clients where there's still a lot of, either founder generation influence or maybe they're generation 3, but there's senior generation influence that are bringing on a next gen, that oftentimes that compensation is this black box that nobody knows what each other's making or why. And I always suggest many of them have access to your accounting system. They can probably find out if they really want to. So if you really think this is a secret, I hate to tell you, it's probably not. So can you defend the rationale of why people are making what they are?
So if you're just chiming in, I'm here with Davon Cook from Pinion, and we're talking about compensation in family companies. We've just covered the question of the difference between being compensated for an owner and being compensated for being an employee. Context, this can be bringing clarity to why and justification for why compensation is being that way, but it also leads to another type of issue that's really important to understand when thinking about compensation in family business. And that is the difference between how we're thinking about profit and compensation from a tax perspective and the implications that it has when your company's small versus when it gets quite large. In a nutshell, there's a lot of family businesses out there, a lot of business owners in general for that matter, that when they're looking at their K1s, the profit they're coming from their business, profit gets taxed at a higher rate, and they want to find ways to bring that tax rate down by spending that profit on viable business expenses. So this might mean, say, office space or a car that you can use for business purposes and so on and so forth. This practice can be a good idea, but it can also bleed into some pretty difficult territories going forward. Davon, can you elaborate on that for us?
Yeah, there's really, I can lecture my clients all day about the best practice of separating ownership and management compensation, but the reality is they have a huge tax incentive to not do so, both by deducting business expenses that I would add, it's not just vehicles, it's in many cases homes. I mean, especially if you think of my clients in rural America in farming or manufacturing, like they may live on one of their production sites. And so those are legitimate. They're often providing housing for employees, family and non-family employees. And the list goes on. Lots of people could be paying some of the healthcare premiums more extensively paying for healthcare premiums for family members if they're a small enough business that they're not required to comply with some of the larger business items there. So it's easy to very rationally make financial decisions to run as many expenses through the business as you legitimately can. And you also, are trying to manage, W-2 taxable income as well. So what that sets up, it starts out very innocuous. Your accountant's telling you, oh, yes, this is legitimate. And it truly is from an IRS standpoint. But sometimes it sets you up for conflict down the road. And so what I counsel folks to do is, as much as you can, avoid getting outlandish with this. And I know we both have traded stories in the past about, top end vehicles that were maybe a little bit hard to think that we really needed for the business. But practical example, I counsel clients to, if you're going to run some of those things through the business, put some process around it, again, being transparent and being fair. So housing, if you all have houses that are owned by the business, is it fair to expect the business to do all the improvements on those houses, or to put in a pool if you want, or to remodel? And that's where family members can get in a lot of conflict, right? Like, you spent $50,000 remodeling this house, and my house is not as nice. So I've done things like set up some policies where a certain amount of profit every year is kind of earmarked and goes to a fund for each person's housing. And so I can accumulate my funds for 10 years and do a grand remodel, or I can spend my funds every year. So I've still got some personal autonomy on those things that affect my life, but we're being fair to each other as business partners. Same thing on vehicles, like have some policies around how frequently we're going to replace people's vehicles and at what level, so it doesn't become a source of conflict.
Okay. Yeah, I think there's, in a nutshell, what you're describing is kind of like a fairness doctrine and a transparency doctrine, right? Those are that you're going to come in good faith to work with your family and understand that if we are equal in the family, that what is being considered in this category of what the company will pay for, there needs to be some level of balance and clarity about how that comes through.
And one more clarification on that before you move on is, whatever those benefits that are going through the business are, make sure they're captured on a total compensation worksheet so that everybody appreciates what they're getting, right? So this is my salary, but here's what the vehicle's worth and the house is worth and the extra health insurance I'm getting and so forth, so that I get a grand total and I'm not kind of feeling undercompensated when in reality that might not be the case.
In practice, when you're thinking about the total value of compensation, and you've got different levels of contribution and family members, or perhaps in this case, different levels of ownership. So one of the ways that we can look at the tax write-offs is if one shareholder owns 75% of the business, they would be entitled to 75% of the proceeds and therefore 75% of the tax write-offs. That's not necessarily how that's handled, though. So on a case-by-case basis, how would you look at addressing that?
I can't say that I've ever had someone handle it that specifically. I like the concept, but I'm not sure it's practical in most of the reality situations I'm in. Now, having said that, the things I mentioned, vehicles and housing, in my examples, those tend to be people that are actively working in the business.
Mhm.
There's a whole nother category of kind of benefits we're running through the business that apply to, younger kids, high school kids. Are we providing vehicle insurance for the whole family while kids are at home? And those are we providing fuel cards to kids that are at home through the business and so forth. And same thing, I'm not going to lecture you all day that it never happens or shouldn't happen. I'm saying do it with some process and transparency so that everybody perceives it as fair and appreciates what they're getting.
Yeah, I mean, there's a trend in this conversation in the absence of clarity and documentation. There is an observable trend of negative assumptions being made about being treated fairly or unfairly.
Hmm.
And in most cases, people are coming with good intentions to treat their people with fairness. And it's the issue is the transparency, not the behavior. And that's not always going to be
Yeah.
true. Certain that there's circumstances that arrive where there is some poor behavior by a person somewhere. But in most cases, there is good faith amongst family members when these things are boiling down, and bringing transparency to them is key in whichever way it happens.
And I think there's a life size of the business and life stage implication here too. When it's two or three of you, you can probably manage all those extras and keep the transparency. But I oftentimes have clients, when we're getting to cousin generation or second cousin generation and there's more people involved, that we do just kind of have to call time out and say, hey guys, this is getting too complicated to manage insurance and keep the transparency where we need it and keep everybody aligned. So we are going to simplify the system and we are going to take the hit and just you're going to get W-2 wages and period, because for a complexity reason, it's time to do this.
Yeah.
So it's going to depend on what stage you're at.
There's one thing I would want to bring into this that we observe is that in the absence of a policy in this case, there is a tendency for companies and family companies in particular to look at the revenue of the company as their personal money in some capacity. And that there is, in some cases, a culture where family employees can go to the CFO or the controller in the business and ask for expenses for it to be covered. And those things will happen, and they will happen without oversight. And that when that can, if you're a G1 and you're the founder and that's what you choose to do, great. And that policy passes on to your 5 children, and those 5 children then have the same practice and they're not communicating, the CFO is now caught in a bind. So imagine you are not in the family in this circumstance, and you've got 5 30-year-old-ish, more or less, adult and children employees. They're all coming to you with expenses, and you are now in a hard place where you don't have a policy. If it's you alone and you're going to your company and pulling expenses and calling them a tax write-off, it's one thing. And then you end up having 5 kids who work in the business and you don't evolve your policy. Those 5 kids inherit the idea that they can go to the finance department of the business and have whatever they'd like expensed. Now, not only does that create a problem in the bigger picture of what's fair and equitable amongst the family members, you also need to acknowledge in the circumstance what it's doing to your staff. So forget being in the mindset of the owner. Imagine you are the employee, where you are now in a position where you have no policy or procedure about what's appropriate. And then you've got direct observation about what the different family members are requesting to be expensed. Whom do you report that to, right? And how are you supposed to handle that? Because if one of the things that's in your mind as an employee is protecting your own employment.
Right.
So
Your own employment and any theoretically you could get into legal compliance issues too that you're now putting an employee at risk for. So
yeah, so transparency in this context has a big issue beyond just ownership, and once again impacts the culture of the business. So I think we've talked through, and the next one is going to be into self-pay, but skewing the opposite end. Instead of paying ourselves a lot of money, we're paying ourselves less than market. So if you're just chiming in, we're chatting with Davon Cook from Pinion about compensation and family business. And we've just covered a thorny question around how to manage tax write-offs in family business. Now, I want to jump into a different question that's something that's very close to my experience, bringing non-family CEOs into family companies, particularly in the case where the incumbent CEO is the owner, operator, founder, or family member of the business. And we find a trend that creates a pretty big challenge to overcome at the beginning of an executive search process. And what you do before we go start to find anyone is we need to pull a compensation study. And so we'll say, we want to hire, say, a CEO for a $100 million ad company, let's say. And when you pull the data, the median is going to be at a specific spot, and the family principal is going to be below the 25th percentile. They say to themselves, I don't need much money. I'm going to reinvest that money back in the business. So what you have is a CEO for a $100 million business that's taken, $100,000 salary. And the person they're going to need to recruit will not accept that. But also then there's an expectation setting amongst the ownership group saying, well, that's not what we pay our people. And there tends to be a case when you don't have a compensation study done or market benchmarking compensation rather, for your family principals. There's likely also not compensation benchmarking done for the other employees within the business. Apply this to a circumstance where you have really low turnover, means that you haven't done compensation benchmarking for a decade or decades, plural.
Yeah.
And that can create a big compensation gap over time, which is going to compound when you need to begin bringing new executives into your business.
Absolutely.
So,
That's one that I don't think people see, but you're absolutely right. I've seen it as well. You're on this slow glide to a problem that's compounding.
mhm.
And it's interesting. I was in a conversation with a bunch of business owners years ago where one of them shared what they were paying some key non-family leaders, and they were sort of ahead, they were ahead of their time in this group as far as being pretty intentional about bringing in some successor leaders that were not family, and the rest of the owners were shocked at what they were paying. And there was just this reaction of, well, I don't even pay myself that much. And it led to exactly this conversation. Well, why not? And what are you doing to yourself? And some folks' answer might be, well, I can't afford to pay myself that much. Well, that might bring to the question of, if you can't, then is the business sustainable, right? And then the second scenario of the answers were, well, you may not think you're paying yourself that much, but if you go and add up all those perks that we just talked about in our previous section of things you're running through the business, you might be paying yourself more than you realize. So both of those scenarios come up, but this shock factor when you go to market is very real.
Yeah. Yeah. Boy, tell me about it. There's a couple things that are worth considering here when you're thinking about executive compensation in this context as well. On one side, there is that owner operator, is there employment compensation at market? But also, we need to take into account their equity.
Mm-hmm.
Most cases, when you're bringing in non-family executive operators into a business, it is a bad idea to compensate them with direct equity. We want to look at phantom stock, profit sharing, something else. Nonetheless, great talent is going to expect some form of long-term incentive. So there's an additional hurdle where you have the incumbent who is underpaying themselves and likely not reinvesting their equity back into the business. And so there's an additional hurdle of how you address long-term incentive for that reason. And the important thing to understand is that when negotiating with non-family executives, if there is no form of long-term incentive, the way around that is going to be an increase in base and annual incentive to get people on board. And it's for this reason that we can get around the issue, but it requires compromise from the family. And that compromise is not necessarily going to make them very happy.
Yeah.
And so the compromise is going to it bifurcates into two directions. Now there's some other options here, but I'm going to focus on two. The first is you find a way to make the money work and
Mm-hmm.
bring a person on board. And the second is you find a person that accepts your compensation practice. And the issue that you're going to face there is if the median is at a base of, say, $350,000 and what you want to pay is a base of 200, you'll find people who will say yes. And those are not necessarily people that you want to do the job.
Yeah. And that's where I'm going to put in a plug for you. That exact conversation is so valuable to have a compensation expert like yourself that is in the market. Because folks in my seat, like, I can see that and I can say that anecdotally, but I'm not hiring every day, right? And so knowing that mentality of the job seeker and that executive that you are trying to attract, I think is so critical And I do see so many of our clientele struggle with that. Certainly don't want to give away actual ownership, but even the long-term incentives sometimes feel either overly formal for just their business structure, or financially feel like a big commitment, or they just want to keep it simple. Why is that? Just sounds complicated. Like, I just want to hire somebody. And so to your point, you got to find some level of incentive that's going to attract the person you actually want.
There's this level of ambiguity. Again, that's another time this is going to come up across this conversation, that is beneficial to the psychology of the owner here. Saying, and where this emerges is that the trend of discretionary bonus, right?
Mhm.
I don't want to commit to you what I'm going to pay you on paper. We're going to see how our year does, and if we do well, I'm going to give you money that I personally think is fair. And that works really well in the mindset of the owner, because the owner views themselves as fair and just and valid. And the new person they're bringing into their system is unproven. So why should we make commitments to them? And the inverse statement of this tends to get lost on family business owners. And the inverse statement of this is that it's my career, and if I expect to be paid what I'm worth, and if you are going to hold that above me, I'm going to take my expertise elsewhere. Right? As a family business owner, you have the right to make the decisions that you do. And as an executive, the executive has the rights to take their expertise where they choose. And those two things need to find harmony in order for this to work well. And if you come into this discretionary pay model, what you're really saying, the way it gets translated as, is I don't trust you. And I don't
Yeah.
want you legally tied into someone I don't trust.
So, Bill, do you think, is it just setting the amount, or scenario I often see is we will say, hey, your bonus could be up to X amount, but we don't, you are brand new, and maybe we're even hiring you in a new position. So I don't know how to put metrics around that to make it, a formula. So my decision of up to X amount is discretionary. Do you see that still be as big of a concern to the employee?
Well, so if you can get to a point where you can say, the discretion, the annual bonus is going to be up to X percent of base, that works a lot better. Just that is better than the word discretionary. But I think we got to kind of bleed into another little area here, because all of these things are interrelated, is that the actual question is governance, right? So if you're saying that you don't trust this person, you need to take a look at decision rights. And if we go back to that number I gave you before of a $350,000 compensation as a hypothetical number, let's call that in your mind a big number. That number as CEO compensation is what's implied there is that person has a wide breadth of autonomy to make decisions on behalf of the business owners. And you are compensating them handsomely and trusting them to make those decisions as what is effectively a fiduciary employee. If you do not trust them, and you're not going to go to give them decision rights that are then you're not hiring someone at that level.
Yeah, don't bother paying them.
So don't pay the money for a person. I kind of like the idea. You see these people in the suburbs a lot of Chicago. You probably don't see them as much out where you are, Davon, but you see a lot of people with big Ford F-150 pickup trucks going to and from the grocery store, and not really being used for what the truck is built for. Right?
Yes, in my clientele, we use our trucks, Bill.
I know. But my point here is, if you're going to buy a truck, you use the truck. What a lot of companies want to do is that the great CEO is the King Ranch Ford F-150. Yeah. And then what the family wants them to do is go to the tune from the grocery store. This is not worth the investment of the truck. But invest in a lower level employee if what you want is someone to go to the grocery store. Does it make sense?
Yeah. Absolutely. And I think maybe that's when people are having the sticker shock of how much it's going to cost to hire this person, is the exact right time to have that clarity check. Well, they are worth it if you are planning to let them do X, Y, and Z. And absolutely that's probably a whole nother podcast, is, what leads to difficulties with non-family executives. And it's often a mismatch of understanding of what their authority is and it's not.
Yeah, well, it's funny you say this. So if you're just chiming in, we're in a conversation with Davon Cook about compensation and family business, and we just had this really interesting kind of foray into non-family executive compensation and the connection of compensation and decision rights. And the next bullet point for us to discuss, Davon, is how compensation is actually the last thing that you should be talking about, right? There's this notion that when you're coming into talking about new jobs or new people and roles, particularly if you're going to my industry, which is executive search, that you're going to talk about title and compensation, when those should be the last thing that we're discussing. First, you need to figure out what the job is.
Amen. I agree. I've seen several family businesses first attempts at, key non-family people, CEO, CFO, something at the executive level fail. And man, that's a hard job to step into, especially the first person. They should get an extra bonus for being first. So all of you listening, you should negotiate for your extra bonus. But it fails because there is not clarity on what the role actually is and what their decision rights are or are not. And
Right.
I actually have some slides, I don't have them pulled up, so I can't quote from them, that I put in front of folks, and I give scenarios. Are you going to be okay if they do X?
Yes.
So are you going to be okay if they let a 20-year employee go? With good reason, with a logical, rational reason. Are you going to be okay if they tell a family member, coach a family member that they're not doing a great job? Are you going to be okay if they, close a business line or change a significantly new vendor? But make it real scenarios to kind of do a gut check with people of, are you being honest with yourself?
Yeah. Yeah, I mean it's the huge gap that's missed in the role planning for these types of transitions. And I think we need to also highlight here that this is also true in family to family transitions.
Absolutely.
Right. One of the things that you can see particularly is from founder to next gens, where the founder operating model tends to be a person that cannot be replicated in terms of role and responsibility and how they manage. They also cannot be replicated in how they themselves were paid, right? Particularly if they had multiple kids. There's the ownership distributions themselves spread in different ways.
Yeah.
But one of the most thorny types of conflicts that we see are if it's owner and a non-owner employee having a fight about decision rights. The non-family employee loses and they get
who's going to win? Pretty clear.
Right? But if it's a G1 and G2 that are in the family, now you're in a different area where you still need to pair compensation with decision rights appropriately. But there's no exit valve that's available where, it's there. But take it at your caution. Firing, family members do get fired, but it means something a lot different than exiting a non-family person, particularly if they're a new hire.
And what I see happen, I've seen you in your consultative process, when I refer you to someone, you immediately say, well, I can go run all sorts of, I can get the data, I can get the comp data surveys for you, but that's not going to answer the real question here, which is what is their real role and responsibility? And, what jobs should we be comparing to for a benchmark? But it's really, people want to address the symptom in front of them, which is, I need some data to know how to pay fairly. It's much harder to dig deeper and address the underneath lack of clarity or maybe conflict that's simmering.
Well, yeah, you dig into there is a need to benchmark data and hire people, but then when you dig into how to get that work done well, you end up needing to have a solid foundation. And that solid foundation might mean, that solid foundation is going to require clarity on role, responsibility, and its connections to compensation. But to get to clarity, one of the things that you'll find is that there is a lack of systems necessary to cultivate it. And so here's a thing. I might have shared this with you before, Davon, but it's a very interesting point of inquiry when talking with family business owners that are also CEOs and are operators of their own company. Ask them for their position description, roles, and responsibilities. Never has anyone ever been able to procure one for me that was valid?
Agreed. Right? I mean, we help folks write them sometimes because they went to a workshop and were told they needed one. But it's still not something the organization is living by every day, to your point. Yeah.
So, I mean, there's two really useful things here. And when you're connecting compensation to role and responsibility is before you talk about this other person, be it your child who is going to inherit your space, or be it some stranger out there in the talent market that you're intending to hire, stop thinking about them and first document what your roles and responsibilities are and what you are paying yourself.
Yeah.
right?
A really practical tool when we get in that situation where nothing exists is we start with like a calendar of duties. Like I literally for 3 months want you to write down what you do weekly, monthly, quarterly.
Uh-huh.
And like build it from the ground. And that serves not just to build a position description, it also serves all sorts of, do you have SOPs for these things that are mission critical? And it serves to thinking about your succession plan, who's taking on different parts of it, et cetera. But it's like this really tangible way that the folks that don't operate in systems where those things exist can start putting it to paper. Otherwise, you end up with like an overly general bullet point list that I got off ChatGPT. I mean, I can search for the, job description of CEO and give you something in 5 seconds. But is that really speaking to what I do in our business?
Right. So we actually use something very similar to that in our work because as I was kind of hitting on before, we try to do is focus the conversation on what the job is. And to understand what the job is, we need to understand how the incumbent is functioning within it. And by not getting clear on what the incumbent's role is and what their pay is, we can then have a baseline for what the future looks like, but also one of the key things that we need to look at there is what change looks like. We worked on a CFO succession project for business in a large metropolitan city, and the reason the metro city is important is because cost of living and expense. Right, like this is, and so we have a business that's about $90 million in annual revenue in a big American city. And their internal CFO is retiring. And their CFO's the CFO, before I get to the compensation, was hired in the mid-'80s as a cost accountant, worked within the business, and there's a model here for employees that are brought in this type of case is that their job description is whatever needs to get done. And so they build trust and credibility, generally with a focus on accounting and finance. But if the shop floor needs to be swept, you sweep the shop, so on and so forth, right? You take out the garbage, no one's above taking out the garbage, that type of thing. So we get to the point where he's in his 70s and he's going to retire. And we say, okay, well, what are we thinking about the compensation for this next person who comes on board? And the owner looks away and he looks at me and says, I'm thinking a starting salary of $85,000, right? And this is a $90 million business in like a metropolitan city. That is a starting salary for that not the compensation for a CFO. And this kind of this thread of conversation about lack of benchmarking and expectations is a really key component to what it is. But what you need to ferret out from that is, why does the owner think that's an appropriate level of compensation? And what does it imply about the person that he's looking for? The reason he was that way is that what he hired for his CFO back in the 80s was a cost accountant.
Right.
Right. And that's where his head is. And that is a different thing than where they are now.
Yeah. And that cost accountant has grown with the business and is an incredibly valuable person, but he didn't come in with those credentials that you're trying to hire today.
Okay. So when we talked to this individual, his business owner, his mindset was about hiring a cost accountant, not hiring a CFO. And what we did ultimately was work with him to get clear on what the needs of his business were, not what the needs of what his compensation expectations were. What he had was a person who did a very good job of growing a small business to a $90 million business. And they are now looking forward and growing into something much more. So we had a conversation about what growth was going to look like, what the financial needs of the business were going to be. And then also the other thing that we did, and this is a useful tool for any recruiter out there that's doing this type of thing, is we showed them what $85,000 will get in the talent market today.
It's like the realtor taking you to the house your nice boy house, and you go, no, thank you.
You say, well, like this is what you want to pay. This is what that money buys, right? Like I know that comes as a shock, but there's the reality of the marketplace. But getting clear, it's not me telling you what the numbers are because that's my opinion, and I'm trying to make money off of this business arrangement. This is what those people. This is what $85,000 can buy in the talent market today. And what your business needs is this. That when we got through clarity, it took the pressure out of the conversation. And ultimately, I'd have to look at the notes here, but I think the final base comp for the individual hired for this role was something like $250K. So they more than doubled, but when the owner understood why and how it fit into the picture, it was there was no more tension. There was no more lack of trust. So it was kind of clear alignment once we got there.
And I would say in that scenario, another alternative to that conversation is sometimes we do realize that I don't need the CFO. I mean, I see that fair amount. Everybody's talking about a CFO. I need a CFO. And when we do dig in, maybe you really need a controller, and that is cheaper. And so your point on clarity is the key.
Yeah. I mean, there's like it is the worst thing you can do is want a controller but hire a CFO. Or right. I mean, and what happens? I mean, and we see this in that scenario. Your accountant that worked with you for 35 years earned the title of CFO, but that is a social title, not one that's correlated with responsibilities. And so you say, oh, my CFO is retiring, I need a new one. But if that person's actual responsibilities align with that of a controller, and what you need is an accountant who's working with your ERP system and making sure your accounts payable, receivable, so on and so forth are functioning well, that is not the job of a CFO. Right? A CFO is financial strategy and management and capital investment. And how are we going to align our growth strategy with the finance and functions of this business? If you take that person and ask them to do your accounting, you're going to spend a lot of money on them.
Yeah.
And they're going to quit.
Yeah. And you're going to be frustrated. So, yeah, those two roles in specifically are ones that often get confused.
They do. It's a big point. Davon, thank you for coming in to chat with us today. This has been a lot of fun.
Yeah, I thoroughly enjoyed it. Thanks for having me.
Where can people find more about you and your work at Pinion?
Yeah, our website is pinionglobal.com. That's PINION global.com. And you can navigate to the Family Business Advising page and find me. I think my email and such will be in your notes here. I would love to hear from anyone to agree or disagree with us. I love learning from others. And also we have a newsletter specifically focused on family business advising. If you'd like to be on that, let me know.
All right. Thanks again, Davon. It's great to chat with you. And thanks everyone for tuning in.